The Nikkei 225 just closed down over 1%, but the monthly, weekly, and daily trends are still screaming strong buy. Most traders see a dip and they hit the buy button, right now. They are all trapped. There is one danger zone and one hidden opportunity right now. I'll show you both. We are sitting at 67,470, and the market is coiling for a move that is going to wreck one side of this trade. Stay to the end. I'm giving you 3 exact levels you can trade tomorrow, including the one invalidation number that separates a bull run from a flash crash. My session bias is fading the rally. We are trending higher on the big picture, absolutely, but the 1-hour chart has flipped neutral and the daily candle is showing exhaustion against a massive resistance wall. We are not chasing this breakout. We are looking for a trap. The herd is positioned long, heavily long, leaning on the strong bi-monthly trend, and that's exactly why the pain trade is a sharp, corrective move lower. Write this number down. If we break 68,537 with a decisive 4H close today, the entire structure resets bullish and we throw the fade idea in the bin. But until then, gravity is not your friend if you're a buyer. The herd is betting on a quiet climb to 70,000. I'm telling you, the market rarely rewards the obvious consensus. The froth is visible in the stochastics, sitting at a blistering 96.7. That is an overbought extreme that usually ends with a sudden, violent mean reversion spike that stops out those late longs. Let's zoom out and walk through the charts, from the weekly picture down to the 60-minute trap. On the weekly, we have a beautiful stair-step pattern. The 50-week moving average is way down at 61,729, and the 200-week is at 54,160. Price is seriously extended above these core anchors. This isn't a buying opportunity at value. This is a momentum chase. The weekly MACD is positive, yes, but the histogram bars are steady, not accelerating. That's our first subtle red flag. The rate of change is dying while price grind higher. Drop down to the daily chart. The 20-day moving average is at 64,553. The index is currently over 2,900 points above its mean. That is a massive deviation. A rubber band can only stretch so far before it snaps back. The daily MACD is printing 1,989, still in bullish territory, but we are starting to see a negative divergence on the 4-hour time frame. Here's what most traders miss. While the price made a marginal higher high near 68,000 this week, the MACD on the 4-hour chart is making a lower high. Buyers are exhausted. It's a hidden divergence that whispers distribution, not accumulation. Now, let's get specific with the levels. Our current battleground is 67,470. Immediate resistance is the local high at 68,537. Above that, we have a psychological magnet and swing resistance at 69,435, and the major wall at 70,085. Support levels are absolutely critical here. The first floor holding this market up is 66,989. That's your swing low. That's where buyers must defend. Below that, we are looking at the 66,340 zone, which aligns with a prior consolidation break, and then the deep pocket at 65,441. The cross-asset linkage is crucial. Keep your eye on the US dollar to Japanese yen. The yen is the shadow driver of the Nikkei. A sudden spike lower in dollar-yen, maybe on an intervention ghost rumor, will punch the Nikkei right in the gut. If the yen strengthens violently, those 65,400 support levels will get tagged faster than you can blink. The movement is almost tick for tick. A weak yen props up exporters. A strong yen kills the index momentum. Yesterday's move, that 1.35% drop, wasn't random. The news headline says Japan stocks lower at close of trade, but the real story is the unspoken BOJ policy pivot fear. The market is pricing in a complacent view that the Bank of Japan will stay dovish forever. But any whisper, any single headline suggesting a move away from yield curve control or a rate hike, will pull the rug out from under this market. We are seeing institutional positioning start to hedge for this. ETF flows have been consistently buying the dip, but smart money is selling call options, capping the upside. They're harvesting the premium from the herd's greed. The 1 to 2 week directional lean is a corrective pullback. I'm looking for a retest of the 20-day moving average, that 64,550 zone, to reset the technical overbought condition. That's a healthy move. The exact event that invalidates this bearish lean is a daily close above 68,540. If we close above there, the melt-up is real, the divergence is cancelled, and we're chasing 70,000. I need to know where your head is at. Do you think the Nikkei breaks 70,000 by the end of next week? Comment yes or no right now. I'm tracking the consensus on this channel to see if the retail crowd is as bullish as the sentiment indicator suggests. Most people skip this section to watch the charts move. That's exactly where the money is made. Keep watching. This is the actionable intelligence, strategy 1, the sniper, conservative. This is the high probability mean reversion fade. I'm waiting for the trap to spring. The trigger condition is a failed breakout above 68,000. We need a 1-hour candle to poke its head above 68,537 but then close back below 68,000. That's the bull trap confirmation. You place the sell order on that close. Stop loss goes above the trap high at 68,600. Tight and logical. Your first take profit target is the daily support at 66,990. That's a clear 1,000 point grab. Your second target is the MA20 zone at 66,340. The risk reward on this is pushing 1 to 2.5. What voids this setup? A clean, strong 4-hour close above 68,537 without the rejection. If the candle seals above it, you step aside. No countertrend trading. The sniper, conservative fade, entry, sell on 1H close below 68,000 after false break above 68,537 stop loss, 68,600 take profit 1, 66,990 take profit 2, 66,340 risk, reward, (1:2.5 invalidation, 4H candle close above 68,537 strategy 2. Or the active trader, standard. You missed the first short, or you just prefer trend continuation plays. This is a pullback buy to the moving average. The entry condition is a retest of the 4H20 MA, currently dynamic around 66,900, and combining that with the static support of 66,989. We are building a confluence zone between 66,900 and 66,990. You wait for a bullish 1-hour engulfing candle in that zone. Stop loss goes below the 66,340 support level to give it breathing room, specifically at 66,250. Target 1 is the retest of the high at 68,500. Target 2 is the 70,000 big figure. Once target 1 is hit, drag your stop to your entry price, guaranteeing a risk-free trade. This is how you ride the primary daily trend without blowing up your account on an overbought spike. Type your Nikkei range for tomorrow. Where do you see the high and the low? Give me 2 numbers in the comments now. Let's see who's aligned. The active trader, pullback buy, entry, 66,989 zone, bullish 1H engulfing candle on 4H MA20 touch, stop loss, 66,250 take profit 1, 68,500 take profit 2, 70,080 risk, reward, (1:2.8 trailing rule. Move SL to entry when TP1 is hit strategy 3, the aggressor, high risk. This is for the sell-side momentum players, the ones who see the stochastic at 96 and know a crash is imminent. This is a breakout sell on the 15-minute chart. You're not waiting for a pullback. The trigger is a 15-minute close below 67,200, confirming a short-term breakdown from the current 1-hour neutral. Flag. Stop loss is tight, just above the breakdown bar at 67,600. Target 1 is the 66,990 support. Target 2 is the aggressive liquidation dump to 66,340. This has a high win rate in overbought conditions but comes with a warning. Only for those who can lose small and manage risk aggressively. If the price rips back above 67,600 in seconds, you're wrong, and you're out. No questions asked. The risk reward is attractive at nearly 1 to 3, but the speed of the move requires fast fingers and zero hesitation. The Aggressor, breakdown momentum, entry. Sell on 15M, close below 67,200, stop loss. 67,600, take profit 1. 66,990, take profit 2. 66,340, risk, air reward. (1:2.8 R invalidation. Instant reclaim of 67,600, never risk more than 1 to 2% of your capital per trade. That 68,537 level is not just a number. It's a volatility trigger. If we are shorting against it, you must respect the stop. No positions through high-impact US or BOJ news. Stops are non-negotiable. This is how you survive to trade the next big move in the Nikkei, instead of being someone else's exit liquidity. The single most critical level for the next session is 66,989. Lose that, and we are in a full-scale corrective freefall. Hold it, and the grind higher resumes, dangerous as it may be. Tomorrow, I'm laser-focused on the Asia Open reaction to any overnight US market moves. If the S&P 500 catches a bid, the Nikkei might just cheat the bearish divergence for another day, but I'll be here to break it down. If you want the full breakdown on Bitcoin's risk asset shadow and the S&P 500's liquidity tide, that video is live now. Tap the end screen right there. I analyze 8 assets daily with this exact institutional rigor. Smash the like button if this gave you a clear 3-strategy plan. Subscribe, hit the notification bell, and commit to trading with an edge. I'll see you in the next one.